All right. Hello and welcome to the Lytham Partners 2025 Healthcare Investor Summit here. For the first event of the conference here, we're going to kick things off with a Fireside Chat webcast with Aytu BioPharma, who trades under the ticker AYTU on the NASDAQ. And joining us from the company is their Chief Executive Officer, Josh Disbrow. Josh, welcome.
Good morning. Good to be with you, Robert. Thanks for having us.
Absolutely. Thanks for kicking things off here. Let's sort of provide a quick high-level intro to A2.
Yeah, happy to. And again, thanks for having us. Aytu BioPharma is a specialty pharmaceutical company focused on commercializing prescription therapeutics. We've undergone a significant transformation over the last 2+ years, which I know we'll talk about here shortly, that has positioned us really well for long-term success. And we're excited about having really wrapped that up recently. Our current focus from a prescription products perspective is in the therapeutic areas of ADHD and in pediatrics. We have a commercial infrastructure inclusive of a sales team of 40+ sales representatives that call in physicians around the country. Two primary product portfolios, as I mentioned, ADHD, and then we have a smaller pediatric portfolio, which we'll talk about. Adzenys and Cotempla are our flagship products. Those are ADHD brands. They're proprietary, compete in a very, very large ADHD market. And then we have a pediatric product line, which is headlined by a product called Carbinol ER, which is a liquid antihistamine that we have in-licensed. And we have a line of pediatric multivitamins that have multiple products that and SKUs in that product line. And then our flagship sort of program, our flagship patient access platform is something we call A2 RX Connect, which we really think is a significant differentiator for the company that really enables us to stand apart, to offer something that other pharmaceutical companies don't, and ultimately benefit patients. And we'll talk a little bit about that as well. So, really focused on driving growth. We're excited about the trajectory that we've captured here recently. And again, excited about our transformation that we've just completed here, really just a handful of months ago.
Let's sort of start with that there, that transformation. If you looked at this business 3 years ago, you had a pipeline, you had consumer products, you had obviously the ADHD and the peds here. For folks maybe not all that familiar with the story, talk about where things were a few years ago, where they're at here today, and sort of where that sort of sets the company up for the future.
Yeah, so if you were to look at the company, say 2.5 or 3 years ago, what you would have seen was a multi-pronged, significant cash burning enterprise. As you said, we were a company that, while focused primarily in the prescription segment with the products that we have today, we had significant pieces of the business that, while promising, were burning significant cash, inclusive of an R&D pipeline. We had a rare disease asset that was poised to kick off, although it was poised also to burn 20 million plus in R&D spend. We had a consumer products company, consumer healthcare company that we positioned to a point of significant growth and minimize the burn, but frankly, couldn't get the burn down to zero. And then we had a manufacturing facility that came with the acquisition of Neos Therapeutics that we completed back in March of 21. And so those three prongs, to call it a 4 or 5 prong strategic sort of approach, were significant cash burners. And so over the last couple of years, we took a step back. We obviously recognized the state of the capital markets and sort of where we were and where we needed to go, and focused very clearly on getting to the next step of first of all, minimizing cash burn to zero and ultimately driving growth. And so it took an inventory of all pieces of our business. And as you would expect, the piece of the business that was driving the most growth was, of course, the commercial business, the prescription side, and also the highest EBITDA, sort of the closest to positive earnings. And so we essentially went about shutting down all aspects of that business that was not really contributing to EBITDA. So we suspended our R&D pipeline. We the better part of a year and a half it took to wind down the consumer health business and ultimately divest that. We completed that divestiture and wind down the middle part of calendar 24. And then we had, along the way, been shutting down the in-house manufacturing facility that resided in Grand Prairie, Texas. That ended quite literally last week. The 31st of December was the end date for our lease. We handed the keys over to the landlord quite literally a couple of days before the holiday break, and have now vacated it, such that now what we are is a very focused, very streamlined straight ahead specialty pharmaceutical company focused on our prescription products, our ADHD meds, our pediatric portfolio. And when you look at that business, it on a trailing 12 basis generated over $10 million of positive EBITDA. And so it's no longer being masked by the cash burning elements of the enterprise, and we can showcase what we are, which is a true to form spec pharma company. And so this obviously sets us up to begin cash flowing, we hope, quite soon. And of course, that cash flow will enable us to invest in further growth in the prescription portfolio, while also enabling us to pursue additional assets as we think about bolting on acquisition targets that are complementary to the commercial infrastructure and to RX Connect. And so that's all long lined up to say we've done a lot in frankly a relatively short period of time to focus the company on what ultimately we think is going to drive the most value, which is revenue growth of our proprietary brands and ultimately dropping cash to the bottom line to invest in the future.
To the point, if anyone that takes a look at your investor slide presentation saw that you lost $25.5 million of adjusted EBITDA in 2021, and to the point you just raised, now a profitable $10 million. So a rather significant adjustment here, turnaround in the last 3 years. Let's sort of talk broader discussion on how scripts are going, both on the ADHD and PED side. And you brought up Aytu RX Connect. Talk about how that fits in the equation. Maybe just sort of educate viewers here a little bit on that program.
Yeah, so our prescription base is largely ADHD. Our products, again, are Adzenys and Cotempla. Just a blurb on each of those. Adzenys is an amphetamine-based extended-release orally disintegrating tablet, so it competes with the likes of Adderall XR. In fact, it is the only brand FDA approved as bioequivalent to Adderall XR, and that product is our largest revenue generator. That's followed by Cotempla, which is also an orally disintegrating tablet, but a methylphenidate formulation, and so that competes with the likes of Concerta and Ritalin LA. And then we have a pediatric portfolio, again, comprised of Carbinol ER and a pediatric multivitamin line called Poly-Vi-Flor and Tri-Vi-Flor. Ultimately, prescription growth is what really drives our revenue, of course. And what I'll say for particularly the ADHD products over the last couple of years, prescription growth has been strong. It's been solid. It's been consistent. A little bit of an anomaly over the preceding, call it 18 months or so, which we can talk about around some stimulant shortages. But suffice it to say, particularly with our product at Adzenys, we have seen really nice growth year on year. And that product continues to perform well in a very large category. Cotempla is a smaller product, more of a stable product in a more of a saturated market and a smaller market. That having been said, it's been a consistent revenue contributor for the company, and we're happy with that growth and significant plans in place to continue to grow that to stabilize, and then we expect ultimately to grow that product as well. Those products have grown, significantly. If you look at sort of where those products were, called a couple of years ago, ADHD prescriptions were just south of 380,000 prescriptions for the whole year, growing to over 440,000 or just shy of that for the year ending June of this last summer. And so pretty substantial growth when you consider, it's a small sales force, relatively small footprint in a very large, competitive, noisy market. And so growing those products continues to be our primary focus. Um, you know, we, but it's important. And then our pediatric products, had grown. We'll talk a little bit about this significantly to the point that they were north of $225 million annually, exhibited some effects from some payer changes that unfortunately inhibited their growth and took them down quite a ways. But we're now back to seeing some positive things, which we'll talk about. But what really sort of undergirds or I think surrounds these products, it's not enough in 2025, now that we're into the new year, to go to a physician or prescriber and simply offer a better clinical solution. You've got to solve the entire problem for the patient, which is equal parts clinical, which is, does it benefit my patient from a features and benefits perspective? Does it solve their clinical symptoms? These do that, of course, by definition. They're FDA approved to treat the symptoms of ADHD in the case of Adzenys and Cotempla. But that's not nearly enough. You've got to be able to solve for the biggest issue that affects patients, pharmacies, and physicians alike, which is payer access challenges. Patients today can walk into a neighborhood Walgreens, CVS, Walmart, or an independent pharmacy, and frankly have no idea whether they're going to get the product that they were prescribed. If they're going to get it, is it going to be received in a timely manner? And if and when they can get it, what price they're going to pay when it comes to an out the door payment, whether that's a copay or whatever the case might be. It's very opaque. The market lacks transparency in terms of whether patients are going to be able to actually get their prescription filled at a price that's reasonable. And that's where RX Connect comes in. This is a proprietary program, and it really is a soup to nuts, top to bottom program that we've developed in-house that is that's mandate is to solve this key issue of lack of transparency and ultimately the inability for patients many times to get the prescription at an affordable price. RX Connect, again, designed by us in-house, is multiple things. First and foremost, it's a network of about 1,000 pharmacies with whom we work around the country. Most of these pharmacies are independent pharmacies in these local geographies that do a good job, and they're small business owners. They work very hard to serve patients very well. The other part of our network is a couple of regional grocery chains that are very, very customer centric, provide excellent service, and work directly with us to stock our products and make them more available. So that's one part of it. Well, what we do is when we sell our products, we obviously sell physicians on the benefits they offer their patients from a clinical efficacy and safety standpoint, and then equal parts tell them that if they will send the prescription to one of these partner pharmacies, they will get the full benefits of RX Connect, which include everything up to including a copay not to exceed $50 for patients that are commercially insured. These pharmacies, first of all, will have it. They'll have it in stock or available readily within the next day. And they will know that their copay will not exceed $50, full stop. No red tape, no fine print, no ifs, ands, or buts. If they are commercially insured patients, they will get our products. We essentially will underwrite the prescription in cases where it's not even covered or there's prior authorization. And even in cases where there's a prior authorization, in many cases, we can help with that and we can help take that burden off of the physician. This helps the patient first and foremost get the product they were prescribed at a price that's affordable. Equal parts helps the physician know that he or she, their patient, is getting the prescription as prescribed on time. These are products that you're going to take routinely, month after month, for many, many years, potentially for the rest of your life. So you need to be able to count on A, being able to get it, B, being able to know that it's available in some period of time when your refill date is coming up, and that you're going to be able to get an affordable price. And so it solves this significant issue. Because today you can walk into your neighborhood pharmacy and tomorrow you may pay a different price than you paid today. That's just a hypothetical example, but and you wouldn't necessarily fill prescriptions back to back days, but quite literally, the prescription price you pay in January may be different than the prescription price, the out-of-pocket walkaway price you pay in February. And that's the way the PBMs have designed it to be opaque and to make it very challenging. And so we have freed up physicians to prescribe our brands without fear of the dreaded callback from pharmacies saying, we don't have it, we can't get it. Or even worse, the parent or the patient calling back saying, this was a really high copay. This was way beyond what I expected or beyond my means. We cut through all of that. So for the first time, it put the prescribing power back into the hands of the patient. And so our products are excellent products. They work very well. They obviously work as intended. They are patient friendly in many ways, but as importantly, the RX Connect program that envelops our products really is what is the game changer that enables these products to stand apart.
That's a great overview, and I think most people probably don't understand all the attributes that go into how these scripts are written, fulfillment, payer, obviously one of the biggest challenges I think we have here. Let's go into some of the trends in ADHD. You touched on them. You know, we've seen growth from a few years ago. There's been a pullback, and most recently here, but maybe talk about sort of that surge that happened, why it happened. And then maybe as we go forward, you know, what's kind of inside, what's in your control, what's outside of your control.
Yeah, so if you look specifically at our ADHD trends, as you said, there was a surge when we looked at, say, fiscal 22 to 23. Prescriptions grew for the ADHD franchise significantly from, call it 380, it was specifically around 376,000 prescriptions to jumped all the way up to 434 plus prescriptions, 434,000. And that was due largely to a fairly pervasive and relatively long-standing shortage within the stimulant market, specifically Adderall, XR, and its equivalent generics. And then later on came a methylphenidate shortage as well. That was less pronounced, but actually lingered for a while. And so what that enabled for us, frankly, was to fill that gap because patients were coming into pharmacies not having a solution. So particularly with our at Zenis, our product that's bioequivalent to Adderall XR, we were able to serve as a substitute. While not automatically substitutable, meaning a pharmacist couldn't just switch the prescription from Adderall XR to our product at Zenis, physicians could be called by the pharmacy, told that this bioequivalent option is available, and change the prescription to Adzenys. And we got some benefit from that, to say the least, growing prescriptions tremendously. Um, and what that enabled for us, of course, was exposure to brand new patients that we wouldn't have otherwise gotten. And of course, prescribers that really, again, we're a small company. While these products have been around for a little while, not every physician is familiar with these products given our relatively small footprint. So it enables us to get exposure to new prescribers and get them on board, such that we have prescribers to this day that really don't even have sales reps calling on them, but they found their way to Adzenys, like it very much, love the RX Connect program and the stability and the predictability and the copay support and all of those things that sort of are wrapped around it. And so it did enable us to get that lift. And what's nice is, even as the shortage has abated, specifically the Adderall XR shortage has abated, and really that product largely has come back online, not entirely, but generally speaking, back to somewhat normalized levels. Even with that, we still saw growth year on year from 434 to 439, which isn't huge growth, but still, that I think demonstrates that even in a market where Adderall dominates, these generics in particular are significant portions of the market. What we're able to see is we have held on to share and continue to treat those same patients. While some patients may invariably go back and sort of fall back into previous habits, we're seeing, again, stability in our prescriber base and stability in prescription trends. And that tells you, of course, a couple of things. First of all, patients are satisfied. As importantly, physicians are happy with it. They're not inclined to go back to prescribe what they used to prescribe, at least maybe not in the same quantities. And so, really happy to see, even though it's less pronounced growth, to still see numeric, year on year growth on top of that, despite the fact that, again, the market has largely normalized. So, and some people have asked, what caused the shortage? Frankly, it was multifactorial. There were supply issues around the active pharmaceutical ingredient. There were some labor issues at the early onset of the shortage that sort of exacerbated things further. Issues with DEA granting adequate quota as the ADHD market was sort of growing coming out of the pandemic with the work from home phenomenon and so forth. So a lot of things sort of played into it, but ultimately we were able to put ourselves on the map, get a little bit more exposure, and now I think we're working from a higher base from which we expect to grow.
Yeah, definitely seen the step change up here. Let's talk about peds. You talked about sort of the revenue from a few years ago. For those maybe not familiar, talk about sort of the trends that we've seen recently, and maybe some of the initiatives that you've put in place here to reverse those trends, which we've seen in the most recent quarter.
Yeah, thanks. The pediatric products, were generating upwards of 25 plus million if you look at just a couple of years ago from, from our financials. That was essentially our fiscal 23 if you looked at that year end. We did unfortunately get impacted by what frankly most pharmaceutical companies do. We got impacted by payer changes, specifically first around the pediatric multivitamins, where large payers sort of created some challenges and stopped covering a big portion of pediatric multivitamins in general, not just our brands, but around the class. And that was exacerbated further that we had some, fairly concentrated bases of prescribing in areas where this payer had large influence. And I'll come back to sort of what we're doing to sort of affect that. And then following that, our antihistamine was affected similarly by a payer change in an area where we had a pretty significant concentration of prescribers, and that product was being largely driven by Medicaid in that particular state. Well, fast forward, and what are the major initiatives that we have to sort of affect and improve both franchises? First and foremost, what we've done at large is we've been focused on clearly diversifying prescriber base, diversifying geographically out of these areas that were, frankly, probably too concentrated, and ultimately getting our products into a wider sort of span of distribution, more pharmacies actively supporting the patients and filling these prescriptions. So that was one piece. Secondarily, really focusing on improving payer coverage. And we've done various things on both franchises, multivitamins as well as with Carbonyl ER, to bring on several state Medicaid plans that frankly we hadn't had before. And that has enabled us to diversify out into some of these new areas where coverage has expanded. And we're very, very pleased with that, as opposed to having all of our eggs in the proverbial one or two baskets to be out many multiples more in terms of states with that are covering our products now. And that's a relatively new phenomenon that we've observed over the last, call it 6 months. And then thirdly, because of these opportunities now that have opened sort of anew, we've deployed sales representatives and shifted some of the resourcing to the pediatric products to get these products back. We're in many more states than we were historically. It was really previously sort of a handful of sales representatives that were really heavily incentivized to go after and promote these products. We've increased that by multiples, and we're seeing dividends already. Very, very encouraged by our latest RX trends and our revenue trends as we look here to report out our December quarter. We will report that out here in February. And, I don't want to tip my hand too much other than to say we're extremely encouraged when you look at the trends coming out of November in through December and how things are stacking up sequentially. I don't want to suggest we're back, but we are getting the products back to a higher level. And I think we're going to be, and we're continuing to see good momentum as we, again, implement on all three of these strategies, which improve coverage, diversify the base of prescribing, and of course, diversify and increase the promotional footprint with the sales force. So a lot has gone into this, but really pleased with the team's effort to get these products back to some meaningful level of revenue. Do they get back to where they were? Time will tell, but they're positioned much better today, I can tell you, than they were previous few quarters.
Wow, that's great to hear. Let's transition a bit. Let's talk about sort of some of the strategic long-term initiatives. You've talked about in licensing. You have a successful history, I guess, of product acquisitions. There's in licensing opportunities, acquisitions, maybe some bolt-on and some branded products. You've got RX Connect, obviously, to leverage all of it. Talk a little bit about how you are looking to the future here.
Yeah, so we have been, as you highlighted there, Robert, we've been built largely through strategic transactions. In licensing and acquisitions has really been our bread and butter. It's my sort of professional background. It's really sort of the background that undergirds the company that we think we're pretty adept at identifying smallish assets that maybe don't fit at a particular place, doesn't have a strategic role anymore. Or in the case of Neos, it was an opportune time for us to come in and acquire Neos back in 2021 as we were seeking to take the next big step. And so our objectives as we think about the mid and long term are ultimately, threefold. First and foremost, we've got to continue the growth of our portfolio, just the organic growth that we've captured on the ADHD side and then have newly recaptured here to rebirth the Peds franchise. That's obviously an initiative that has already started, will continue, and isn't necessarily a long-term goal. But it is what's going to drive obviously the near-term opportunities to ultimately build cash flow to feed into the longer-term objectives. Along the way, of course, we are continuing our cost containment. We've done an outstanding job of driving down our operating expenses. Both sales and marketing and G&A have come down materially, and I'll point you to our latest investor deck that really highlights that, just to see how much our costs have come down to drive EBITDA and ultimately we think cash flow. And so we'll continue to do that, but we're going to be smart about targeted investments in our commercial products. And then third, and ultimately I think what will drive even more value is diversifying the prescription portfolio by virtue of in-licensing assets and or acquiring those. Again, that's our bread and butter. It's what we think we do well. And we'll be to the point of, hopefully cash flowing soon such that we can go after incrementally larger opportunities. But for now, the appetite is smallish, tuck-in things that we can bolt on. And things that we can bolt on that fit, first of all, within our commercial footprint. So sort of, the types of products we sell now, the types of physicians we sell to today, products that fit within RX Connect, which frankly could be relatively broad-based and frankly therapeutically agnostic, because RX Connect really is an economic engine. It's not so much a physician-centric issue. And look, we've just launched in the very early stages of launching a small ADHD product called Metadate. And so it's our first sort of foray into non-Aytu products. While this is a product that we've licensed, it's sort of an indirect license, but we essentially are attempting to bring back the brand Metadate and relaunch it back into the US market, and doing that through RX Connect, but also putting some Salesforce promotion around it. And so that's sort of the first foray into expansion beyond what is Aytu today. And we've got our eyes on additional assets. The near-term objective is to generate cash flow. And I'll point out, first of all, that, we are really doing a pretty good job of managing cash, and our cash balance is, essentially static to what it had been. We'll talk about that here towards the end. But ultimately, our idea is to continue to bolster the portfolio, diversify the revenue base further, and give ourselves a solid base of revenue that positions us for revenue potential in the hundreds of millions of dollars of annual revenue.
Couple minutes left here. Yeah, let's talk a little bit about the balance sheet valuation here. You've got cash, pretty simple cap table. I know there's a detail on your slide deck, but maybe for those not familiar, walk through the balance sheet and the valuation here.
Yeah, so balance sheet's really healthy from a cash perspective, and the cap table is relatively straightforward. About $20 million in cash as of September 30. That compares with essentially the same cash number as of June 30 and even March 31. So again, relatively stable cash balance. We and expect to do a good job of managing it as we go forward. We do have some debt, all in if you were to look at our liabilities in the context of both a term note as well as a revolver. As of September 30, we're looking at sort of $16-ish million in debt. 12 of that is essentially a term note. The rest of it is really a working capital revolver, so essentially just a line that we tap periodically for working capital purposes. So it's really in real terms, real debt. It's 12 million. And that's a note, by the way, that doesn't mature until 2028. So we refied that a while ago and kicked that maturity date all the way out to mid 28. It is an amortizing note, so we're paying $500,000 in interest quarterly, so we're whittling that down pretty nicely, such that at the end of that term, principal will be down to south of $6 million. So pretty, and we're doing that because frankly, we'd like to whittle that debt number down and get ourselves to the point that we're obligation free. And so when you put our balance sheet in the context of shares outstanding and just overall equity value, and the company trades more or less in kind of an 11-ish million dollar enterprise value range, which for those of you sort of keeping score, I mean that's something approximating 1 times EBITDA. In the specialty pharma world, you would look at a customary valuation in the 8 to maybe 12 times range. 10 kind of settles in around the median and the mean. So that gives you some perspective, at least how we think about valuation relative to peers, that there's probably a big disconnect when you look at enterprise value to EBITDA. So we think, if there's people that are taking a look at the company now, particularly having just completed this big transitional phase and really squarely focused on driving cash flow, probably a good time to be looking at the company, relative to its valuation. And I think we've got the right plan in place, frankly, to really begin to extract significant value with the company, with all the things that are underway and that we expect here going forward.
Fantastic. Josh, we're up against the clock. I'm going to leave it there. Thank you very much for your time today. Thank you to everyone here for watching as well. I want to remind everyone, if you have any questions, would like to schedule a meeting, please feel free to reach out to me, Blum, BLUM, at lythampartners.com. We have a full day of presentations and fireside chats coming up, so please don't go anywhere. Again, Josh, thank you so much for your time today.
Thank you. Thanks for having us.